Hello, it's Jack here, System Trader, and in this short video I'm going to talk about the Merriman Ultimate Buy and Hold portfolio. Let's get started. The Merriman Ultimate Buy and Hold portfolio was introduced by well-known Paul Merriman, and the main goal is that we want to have less risk than if we would just keep S&P 500, 500 biggest companies in United States, while having a similar returns. And in the example which I will show you in a second, I will use 60-40, meaning that we will have 60% of stocks and 40% of fixed income. But the risk, the amount of stocks, it has to be adjusted per investor because for someone 50-50 may be better, or even less stocks. For others, maybe they are more aggressive and they are willing to have more risk and having more stocks in the portfolio. But 60-40 is a classical proportion of stocks and fixed income, therefore I also use it. Similarly as Paul Merriman is using in his materials, 60-40, just to present the idea behind the Merriman Ultimate Buy and Hold portfolio. And the portfolio is massively diversified. Paul Merriman is really willing to have massive diversification in his portfolio. So we are having value stocks, we have small company stocks, we have real estate funds, we have large cap stocks, we have short to intermediate term government bonds. And here's the picture I took from Paul Merriman's website, where he shows, let's say, 6 steps how to build a better portfolio. And in the first step, and he's simulating the portfolio on the data between 1970 to December 2012. In the first approach, he just puts a simple 60-40 classical approach, meaning S&P 500 in the place of stocks and bonds. And the standard deviation is, as we can see, 11.6 and the return 8.5 per year annually over that period. And now Paul, in the subsequent steps, is trying to improve that portfolio, so having no more risk but having a better return. And what we get here is we can see that first Paul modifies bonds, so he basically is using short-term bonds, intermediate bonds, and tips also, but he's trying to avoid long-term bonds because basically, as he says, the yield is also growing with the maturity of the bonds, but the volatility as well. Therefore, he prefers to have bonds in his portfolio of shorter duration. And then in the third step, he adds REITs, so the real estate funds, and then small cap. And as we can see, the small cap stocks are really a big changer because the small cap and value is increasing the annualized return over that period. Still not so much increasing the standard deviation, which is the risk. And in the last step, number 6, he's going global, meaning that rather than only focusing on the American stocks, he wants to have also the exposure to the international stocks in his portfolio. And you could say that, as we can see in the first step, the annualized return 8.5 versus the return 10.5 is not a big deal, because we see that in the first step we have 8.5, and in the last step, after all these modifications to the portfolio, having the same amount of stocks in the portfolio and the same amount of bonds, we are having better returns. And you could say that it's not a big deal. In fact, for that period of over 40 years, as we can see, the portfolio one would have from the initial $100,000 would grow to $3.2 million, whereas the Merriman Ultimate Buy and Hold would grow to $7.3 million, which is a huge difference, because after 42 years, having or not having extra $4 million, I think that there's no one who would say wouldn't like to have that extra $4 million in his pocket. Here is the implementation I used in my software, System Trader. And I'm using here 12 ETFs. So you can, maybe I will just increase it for a while so that you can see what ETFs I'm using. But basically, you can also go to the Paul's website, and he's talking about what ETFs, best in class ETFs, you could use in order to implement such a portfolio. And in details here, you can see that we have, as I said, 60% stocks. We have 6% of the S&P 500 large cap index. We have small cap stocks from America, 6%. We have the international, so let's say outside of United States stocks, 6%, REITs, 6%. Then we have emerging markets, 6%. Then we have international large cap value, 12%, and small cap value international, 6%, US small cap value and large cap value also from US, both 6%. And in total, this is 60% of stocks. And then we have fixed income. We have 10-year government bonds, 20%. We have 8% TIPS, Treasury Inflation Protected Securities, and Treasury bills, 12%. And such portfolio, if we simulate, we have results here. And after from the end of 1972 till the end of 2020, the initial $100,000 would grow to $9.8 million. And here we see benchmark S&P 500. And obviously, yes, you can see here that within that period, S&P 500 would have more, would gain more. But this is not a fair comparison, because this is purely 100% stocks, whereas here we have 60% stocks and 40% bonds. Therefore, there's no magic that indeed only holding 100% S&P 500 in portfolio would give us a better return. But look at this. There's a massively bigger risk in just holding S&P 500. So it's more theoretical, because I cannot imagine that a lot of investors would be able to hold S&P 500 forever in their portfolio. For example, the maximum drawdown in ultimate buy and hold is 35%. So the worst time in the history within that period of time, between 1972 to the end of 2020, we would have to go through the drawdown of minus 35%, whereas holding S&P 500 would give us minus 50%. It's a huge difference. Also, there's a huge difference in standard deviation, which means the volatility. Here we have the standard deviation of annual returns on the level of 10.6%, whereas in the case of S&P 500, it's 17%. So that's a huge, huge difference. All in all, if we take that period for the ultimate buy and hold portfolio, we can see that we had 41 years winning and losing years. There were 7 such years. In the case of S&P 500, that was that we had more losing years, 10 losing years. And here we have the rolling returns of the buy and hold. And as we can see, here is the example of 3 years rolling returns. So there are only 2 cases within that period of here, as we can see, 48 years. So within 48 years, there were only 2 periods when 3 years return were below 0. And there were none period that after 5 years your portfolio would be below zero. I mean the return. And here we can see the in the green line the ultimate buy and hold portfolio, whereas in the blue line we see the S&P 500. This is the value, the equity line, and below we see the drawdown, and in the red line we see the drawdown of ultimate buy and hold, whereas in this purple we see the S&P 500. And as we can see, indeed, S&P 500 has a more severe drawdowns, especially in 2008, 2009. It was over here 40%. Excuse me, almost 50%. Whereas for the Merriman Ultimate Buy and Hold, it was 34, if I'm not wrong, 35%. So definitely it's less risky to have Merriman Ultimate Buy and Hold portfolio. And here we can see the histogram of monthly returns. And for example, we can notice here that basically there was 1 month where, for example, the return was negative minus 15%. And it was just only on one occasion. There was, and this is very extreme case. But on the other hand, we have plenty of months, like over 200 months, where our return was between 0 to 2%. And if you would like to know a bit more about this portfolio, I really encourage you to visit paulmerriman.com and the link I provided here, which is describing that portfolio. But in general, I really hugely recommend that website, because Paul is really giving a great content, and it's really really great stuff you can find there, and I really encourage you to go through it. And if you would like to play a bit more with your own portfolio, with your own risk preferences, you can download my software, System Trader, and just give it a try to see how you can adjust your portfolio to meet your requirements. Thank you very much for your attention, and thank you. Bye-bye.